Are we good now? Sorry about that. Sorry about the mic. Are we good? Yeah. So welcome to a new edition of the live stream. This is Ashraf Laidi with Eightcap at a Trade Zone. I was saying when I was muted that today could be a pivotal day in the markets, but I chose the wrong word. Pivotal meaning when there is a change in market direction in a way, but it could be something that would reinforce the current move. And this is what I mean. We have jobless claims today, and we have core PCE price index. I'm having issues navigating with the mouse here, so bear with me. But the idea here is that we have jobless claims, and we have core PCE price index. Okay. And the jobless claims, basically, one of the ideal scenarios for gold. Okay. One of the ideal scenarios for gold, and one of the ideally negative scenarios for dollar yen would be if we get a higher than expected jobless claims and we get core PCE price index to be on the weak side. Okay, so let me, okay, I'm sorry for all these multiple windows that we've opened. Bear with me a second. Okay. Okay, so basically it's a 1:30 p.m. This is when we're going to 1:30 p.m. London time, GMT. It is really difficult when you're having issues with the mouse, and we're doing a live stream and everything works perfect. Okay, so we're just going to go over what I usually go over, which is the 13-week and the 10% pattern in gold. Okay, so basically, if you go to the weekly chart, okay, what you will see here, you will see that since the low of 1810, okay, we counted how many times we've counted. We've counted 1, 2, 3, 4, 5, 6, 7, 8, 9. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So we counted 9 weeks. That means there is, if we go into the 12th week, this means that we could have 12 to 13 week of another upcycle. And what am I talking about? We've spoken about this in the previous videos, but basically every main upcycle in gold lasted 12 to 13 weeks from this bottom to this top. Okay, or like I said, I'm having issues with the mouse. Or you can see the last 3 cycles in gold have lasted around 12 to 13 weeks. Okay, so this means, why is this important? Again, one thing is the analysis, the other thing is how to interpret it. This means that if you see a high, if you see 2075 today in gold, okay, if you see 2075 in gold, or let's say tomorrow, that's not necessarily the high, the high would be after 3 to 4 weeks from now, meaning 12 or the 13th week. That means potentially it will be with the FOMC week. Why? Because the FOMC meeting, okay, is on Wednesday, December the 13th. December 13th. That means that any high in gold, whether you see 2070 today or you see it 2090 next week, the high is unlikely to be that. The high would be using a specific analysis, and it could be in the middle. So next week will be the first week of December. So we're talking about the second week would be FOMC. So it's either on the FOMC week, which is the week of the 11th, the 12th, and the 13th, 14th, or it could be the following week. Then we have to be careful. And so if we're using time cycle analysis, in a way, time analysis, then this could tell us that the high would have to be somewhere here where the mouse is. So we could be around, we could be around here. So the high could be 2100 or 20 or 22. But as for price analysis, what we said in the other analysis, what we said that the practice that gold tend to do is that it falls. So it falls 10%. Okay. So it goes for, it rises 10% from a main low. It rises 10%. It retraces percent. It retraces 38% like it did here. Okay. So this was on the daily chart, you would see that. It retraces 10%. It retraces 38. It goes back up to the high. I'll show you what I mean by that. And then it goes another 5%. So what does this mean? That means what gold did here, if you see the rectangles, the upper rectangle and the lower rectangle. So the right rectangle on the red one is the main low. Going from this rectangle all the way up to this high is what? Is 10%. So the market drops. So now we're in the daily chart. So the gold does a major low, rises 10%, retraces 38%, or 38 or 39 or 30%. But this was a confluence. This was a confluence of support because when it fell, it respected the 200-day moving average. It respected the 100-day moving average, which is the green, and it respected the 55-day moving average, which is the purple. Okay. So what it did the 38%. It went back up. It retested the high, and the idea is that it usually goes another 3 to 5%. So if saying 5%, so 5% of the high, meaning 5% of the previous high, which is 2000, would give you what? What's 5% of 2000? Is 100. So that means that the target could be this time. We will finally, are we finally going to break that big resistance of 2070, 2080, and are we going to finally hit 2100? Okay. So this is the key. Okay. Now, what we could do is that what about the retracements? Because right now, today, we have a key indicator. Okay. We have a key indicator. So let's say what is the risk for gold? The risk for gold is if jobless claims fall again by another 20 grand or at 20,000, or the core PCE price index comes in higher. It comes in higher than expected. So you would want a soft core PCE price index, and you want a high jobless claims. If jobless claims, let's say, fall back to 205,000 or 200,000, and if core PCE price index does not drop, then I think that it would be time for gold to correct and it could correct, I would say, towards 2018, 2017. Okay, so if you do a trend line support, and I'm having issues here with the mouse, but if you draw a trend line support here, you will basically get a trend line support from around 2018 to 2017, and basically there is many ways of playing this. Now you could get a very friendly double release, meaning again a weak jobless claims, a high jobless claims and a weak core PCE. And if we do get that, then gold could easily go to 2055. But if we do get a gold negative number, meaning again core PCE price index, and do not confuse the core PCE price index with yesterday's core PCE. Please, please, please. I'm actually going to, Steve, I'm going to focus just on gold today, and because of the technical issues, but I'd rather focus on one thing and start moving left and right from one chart to another, and spend and waste time. But if we have again, so the PCE that we had yesterday, that was part of the GDP number, and the GDP number is a quarterly number. Today, the core PCE is part of the personal income and the personal spending data. Okay, personal spending and personal income data. In it, the important component of that is the core PCE price index, which is expected to soften. So if it softens as it is expected to do, then that would be positive for gold. Okay, so bear with me a second. Now, the negative scenario for gold, once again, is the following: is if we do drop, then we will have to retrace toward 2018 or 2017, probably not more than that. Now, some of you might be saying, hey, Ashraf, how about going into a long and a short? What does that mean? So here's what you can do. And I know a lot of people say, no, it doesn't make sense for you to go on a long and a short, because eventually you're going to have to close either one of them, and so on and so forth. But if you can do that if you do your OCO and if you do your stops. So let me give you an example. I could use the 4-hour chart, but I'm not going to use it because of the issues here. So I'm going to do the daily. So what you can do is that you can put a long, okay, you can put a long at 2018, target 2029. Again, you would put in a long, an entry, an order to enter around 2018, 2019. You would if it goes down there, you would target 2029, and then you would put a stop around 2015 or 14. Okay, so you've gotten at 18 and 19 or 19, you've put a stop around $4 or $5, and you are targeting 10. Okay, not at the market, you would put the order there, and then you would have that. And then the other thing is that you would probably have a long or don't trade. Do not make a trade. Just leave one, an if done order, and then wait for the data. If the data is strong and it comes in strong, if the data is gold and gold positive, because we have to be careful when we say what is strong, what is weak, because if core PCE is strong, is high, that is bad for gold, and it usually is bad for indices. And but you want jobless claims to be, when they say, what is a jobless claims? What does weak jobless claims mean? Weak jobless claims meaning there's more people asking for jobless help, for help on the joblessness. So if it's a high number, it's weak, and that's what you want for gold. So if we do get that, then we could see gold easily rise by $15 to $17. I will say this again. If core PCE price index today at 1:30 p.m. London times GMT, or 2:30 p.m. Central European time, okay, or 5:30 p.m. Dubai time, if the number comes in gold positive, and again that means core price index will be soft or it weakens and jobless claims comes in high, then that is a gold friendly number. It's a silver friendly number. It's a dollar yen negative. Then if that happens, then gold, let's say the numbers comes up and gold is at 2040. Gold could easily go to 2055 easily by $15. If the number is really gold negative, and that means that core PCE does not fall as it is expected, and jobless claims weaken, then we could potentially see a nice profit taking, and we could see gold, if it's trading at 2040, then gold could easily go towards 2020, and then it goes to 2018, and that's where you would have your entry. Is this clear? Is this clear? Now, I'm going to try to go into this gold to silver, and gold to silver ratio is something very important for me. I'm going to tell you how I use this metric. And again, I'm not going to have any moving averages here. But here's what I want you to know, is that usually when the gold falls against silver, okay, I'll say this again, when gold falls against silver, that usually happens when the dollar is falling, and usually it happens when gold is up against the dollar and when silver is up against the dollar. So I'll say it again. When the gold to silver ratio weakens, that means when gold is buying less silver and it's falling like it has fallen, and you can see this, what is happened. It hit a high in early November, and then it fell quite sharply. And that decline in gold relative to silver, that means it's called the mint ratio. How many ounce of silver gold buys? If it starts to buy less and it falls, that usually happens with an environment of a weak dollar, as you can see. Yes, the dollar fell during this period, and a period of rising gold versus the dollar and rising silver versus the dollar. Now, I'm not going to get into the reasons why and so on and so forth, but well, part of the reasons is because the silver market is usually smaller than gold, and it's all on a relative basis. But when that happens, it seems that if gold to silver ratio is stabilizing here, and it's found a support, that means that euro dollar could be finding a support, a resistance, and dollar yen could be stabilizing. I said this many times, I have issues with the mouse, but I'm just going to try to do two more things. I'm not going to do indices, but I'm going to go into dollar yen, which is important, okay? And because dollar yen, obviously, it pays attention to what yields do. Dollar yen, this is, there was something that we have in the WhatsApp broadcast group that we've been targeting 146.60, 146.70. We were looking at 146.60, 146.70. We have tested it, hit it actually yesterday, and because that coincided with around 100-day moving average, which is the green indicator here. But here is the way that I look at this is that if the numbers they show strength for the US economy, that means that if core PCE price index does not fall, and if jobless claims weaken, then that is good news for the economy. That could probably push dollar yen back towards 145.80. Sorry, 147.80, 147.90, and that's what you could probably be considering further fresh shorts. Okay. Now, some people said, well, okay, it seems that dollar yen has found a support. Isn't it a good thing here for me to? Some people said, how about I do this, Ashraf? I would go long gold, and I would go long dollar yen, because usually dollar yen is usually inversely related to gold. So when gold goes up, dollar yen usually goes down. But if you want to hedge yourself in a way, so what you can do is, and it's all about the levels. So what you can do you could stick with that if done order in gold, all right, around 2018. Okay, assuming the market is going to go down, assuming that gold is going to go down, and if you assume that dollar yen is going to go up, that's one of the strategies you can do. So you can buy around 147.56. You can target 147.80 or 40. It's around the 40 pips, and then you can put just a 20 pip or 10 pip stop. But if you choose not to do that, and dollar yen does go up, then that means that gold is going to go down, and as it goes down, it would drop towards your 2018 entry, and then it will be triggered, and then you'll push higher. Okay, so this is really one of the ways to play this. Let me just go to Aussie dollar, because we've had two important levels that were hit, and these were the 200-day moving average, which is around 65.80, and then we had 66.60, 66.70, and it worked like clockwork. Okay, so why we basically said that the 200-day moving average was 65.80. Okay, it was a key level. All right, we broke above that, we targeted that, and then we said, if you saw it in the video, all the previous video that I did here for all the last 3 previous videos, we did the weekly trend line, and the weekly trend line told you that if we break 65.80, 65.90, we're going to go to 66.60. It was as predictable as that. And it was and how did we get this 66.60? We got the weekly trend line. I'm going to go into the weekly chart here. Again, we're having issues here, but yeah, thank you for the computer to be saving this trend line, but it hit it like clockwork. Okay, there you go. So yeah, yeah, here we are. So this trend line, the red, the falling red trend line, and if you can see, the market respected 66.60, and then it came back down. Now, what's important about the trend line resistance, why I was going on about the 66.60, is because it coincides with the trend line resistance from summer of last year, not this year, and the 55-week moving average. The key right now is that if we do come back down, I think the previous resistance is really going to act as a support. So even if we break below the previous resistance of 65.90, we're looking at really 64.95. So we are right now at 66. For those who have missed the boat, who did not take profit at 66.60, you can hang around there. So you have a 60 pip range, and then you can be putting at a stop around 65.70. That's basically that. So let's leave it here, and I'm going to turn it around to Steve, and thank you very much. If you have any questions, or if you have any questions, please send them to the team, or you can tweet me at Laidi. Thank you very much. Good luck. Once again, it's the core PCE price index, and it's the jobless claims that are really important.